Thank you for tuning in to the Market Update with Russell Calkins for this October 3rd, 2018. Currently, it's 8:33 a.m. Arizona time. Well, let's just recap on our position. This is basically a recap on what we have. We have two positions, actually three positions. We dollar cost average on the oil. But I want to explain a little more because of some of the commentary I've been getting on how this all works, okay? Why we dollar cost average, how much money should you use dollar cost average, where should I put my stop loss, when should I take profits, those sort of things. So we're just going to get right into it. Now let's just go ahead and get it on the market. We went ahead and got filled on the unleaded gas at $2.11 a gallon. The last is $2.115. So right at our price on that. Crude oil, our first crude oil position, this is November crude oil 2018. Our first position, we sold it at 73.80, and our second position, we sold it at 75.41. Currently, the last quote on crude oil, if I can look at the current quote here, the last quote on crude oil is 75.22. So obviously, we're in the money almost 20 cents on the last position, but we're out of the money on the first position. However, you have a dollar cost average price of 74.60, you're in a real good position. It's not high enough to dollar cost average on our third trade. In fact, it'd have to bust 75.41 significantly for us to dollar cost average the third trade. So let's get right into the reason for this video today. All right. First of all, let's talk about risk capital. This is what I would do if I were still a commodity trading advisor. And again, I was a commodity trading advisor, a cash, gold, and silver broker, a rare coins dealer, United States coin dealer for over 40 years. All right. So I used to trade over 3,000 contracts a week. That's a lot of contracts. Okay. So, 3,000 contracts of the S&P 500. Now, I always did the options markets. I would do way out of the money options, which is never recommended. I always do opposite of what anybody recommends, and I always do the opposite of where the trend is. So if the market's shooting straight up, I'm looking for a reason to stay on the sidelines or go short. If the markets are crashing, I'm looking for a reason to stay on the sidelines with my short positions and go long. As you can see, crude oil has been going up. We're selling the crude oil. Unleaded gas has been going up. We're selling the unleaded gas. When lumber was crashing the other day, we bought the lumber. We did very good on the lumber. So this is how the risk capital works. You take the risk capital that you're interested in risking or losing, we call it, the amount of money you're willing to lose. All right, you take that dollar figure and you divide it by 10. So only take 10% of it. Now that 10% of it, you divide it by 4. So now you can dollar cost average comfortably up to 4 times. All right, depending on how much money obviously you have to start with, but generally speaking, I'm just telling you what I would do trading for my customers. So if I make a recommendation to sell a market, our study indicators are already to the point where the rubber band's pretty stretched out. If we're able to dollar cost average, and we want to dollar cost average against our position, never for it. For why would you want to, raise the price of your buy if you're wanting it to go up? And why would you want to lower the price of your sell as it's going down? That makes no sense to me whatsoever. However, people do trade that way, and some of the people that trade that way do very well. And again, I'm not against any traders out there. I'm a position trader. So I think out of the 115 trades that we've done since we started the market update with Russell Calkins, we've not lost any of them. Okay, 97% big money, 3% fair money or good money. So first, if it's stretched out, the rubber band's 1/4 of the way stretched out. When you let go of it, it's going to go 1/4 of the distance that it normally would if it's stretched all the way out. All right. So if you're able to dollar cost average the second trade, in other words, it's going against you higher and you're selling it, wanting it to go down, now you've got the rubber band stretched 50% of its max. And then, of course, your third trade, 75%. And then your last trade, you're at 100%. And if you're blessed enough to get $4 cost average trades, to me, that's the best thing that could happen. One moment. Been doing a lot of talking today. So that's how that works. Now, I use investing.com because it's free. Also, if you want to day trade or if you want to paper trade any of these recommendations, so you're not using any money, that would be good for a starting point. If you're ready to put real money in it and you watch these past videos and you feel like that you can trust these recommendations, which I don't know anybody that's called 115 position trades. That means I've held them generally overnight. There's only one position that we got in 115 trades that we sold out the same day, but it was such a big profit I couldn't resist it. It was the S&P 500. All right. So you want to look at all 65 commodities that are most actively traded. You want to look at something that it's at a record high, or something that using the Bollinger Band, you're at the top of the band, you reverse it and want to sell it. If you're in the bottom of the band, you want to buy it and reverse that position. But you got to combine it with other study indicators. They got to both match up. That's very important. All right. Because just because it's at the bottom of the Bollinger Band doesn't necessarily mean that it's the right time to get in. So you use things like the relative strength index, the fast and slow stochastics. And again, on investing.com, under your study indicators, there's little icons up there. Just test these little icons. You'll find where the study indicators are. In fact, they call it study indicators. And learn about them and paper trade at first. But if you're ready to put real money into it and you follow these recommendations for the last 115 trades plus, congratulations, because you're making real good money. So we're just going to hold pat. This is more of an educational video today. Normally I'll give you a brand new market. Let's just go ahead and try for a brand new market tomorrow. And of course, past performance never guarantees future profits. Thank you for tuning into the market update with Russell Calkins. Be sure to tune in tomorrow for a brand new market, unless we are able to dollar cost average the unleaded gas higher. We're always using the most active month, and we're also able to dollar cost average the crude oil higher. And may God bless you.